morning, this is Kevin Zhao, your finance professor at MTSU. In this video, we will discuss three important issues. The first one is to wrap up the required rate of return. We will actually summarize what we learned during the previous chapters in just one equation, cost of equity. Then the second issue that we're going to discuss is cost of debt, and we have three methods to estimate cost of debt. And then the last issue is put everything together to compute cost of capital. Okay, three issues: cost of equity, cost of debt, and cost of capital. You may have one question: why do we need to deal with all three costs of capital, equity, and debt? The answer is all three are discount rates that we are going to use in stock valuation. See, the basic method for us to come up with stock price estimation is to discount future dividends or future free cash flows in the stock by using a discount rate. That discount rate is the required rate of return if you use equity related cash flows. But if you use the firm related cash flows, such as free cash flow to the firm method, then we need to use another discount rate, that is cost of capital. Anyway, let's start with our discussion on this cost of equity. And here you see one equation, and this equation actually covers several different chapters. In order to calculate this cost of capital, cost of equity, we use CAPM model, capital asset pricing model, where the cost of equity equals risk-free rate plus beta times risk premium. And here we have three important parameters to estimate before you could estimate the cost of equity for a given company. The first one is risk-free rate, and the second one is beta, and the third one is risk premium or equity risk premium. And here I want you to know that as a professional financial analyst, you do need a big toolbox to estimate cost of equity. So let me go through all those tools that we learned in the previous chapters in this one simple equation. First of all, that is the risk-free rate. How do we estimate the risk-free rate? Well, we have three primary tools. The first one is US 10-year T-note. US 10-year T-note. And the second one is US TIPS rate. Period inflation protected security TIPS rate plus expected inflation rate. And the third one is the long-term growth rate of US economy plus the expected inflation rate. So those are three main tools that we use to estimate risk-free rate. For international securities, we have to deal with the country risk premium for this risk-free rate. And once again, we have another three tools to deal with foreign country risk-free rate. The first one is to use CDS spread, credit default swap spread, to estimate the country risk premium for a given country. And the second method is to use currency exchange rates for a foreign country to compute its country risk premium. And the last one is relative volatility of foreign stock exchange versus US stock exchanges. So once again, we have another three tools to estimate foreign risk premium to come up with foreign risk-free rate. So that is a risk-free rate. The second parameter is beta, and for beta we have four major methods or four tools to utilize. The first one is market regression method, and here we regress individual stock returns against S&P 500 or market return benchmark return to get estimation of beta. That is a market regression method, and here you have to make a choice regarding time length of the data. the interval of the data as well as the benchmark. And the second tool in estimating beta is to look at experts' opinion, that is a service beta, and the most service beta actually incorporate a mean reversion of the beta into their estimation. Mean reversion means if the current estimate of beta from market regression is higher than 1, then in the future it has tendency to go towards 1. If it's less than 1, it will go upwards towards 1 as well. So that is service beta. And the third one is the bottom of beta. That is so-called fundamental beta. We look at 3 sources of riskiness in a firm to come up with estimation of so-called fundamental beta or bottom up beta. What are 3 main sources of risks in a firm? Well, the first one is business mix, the nature of the product and the services to see if it's a defensive business or cyclical business, and typically cyclical business is more risky than defensive business. And the second source of the risk is operating leverage. For a company that has a large proportion of cost is from fixed assets or fixed costs, then it has low operating leverage and high beta. And the third source of risk is financial leverage. The company that borrows more money, of course, is more risky. So here we introduce the method of calculating levered beta versus unlevered beta. And the last tool that we use to estimate the beta is accounting beta, which is not suitable for short-term beta estimation, but give you alternative view on a company's long-term beta estimation. So that is second parameter in this equation, beta, and we covered this during the previous class. And the last parameter is equity risk premium, which is the difference between expected market return and the risk-free rate. And here we have 2 major methods. The first one is historical equity risk premium, and historically this number stands between 4.5 to 6.5%. So if you choose any number between those in this range, it will be a reasonable estimation of ERP. And the ERP has something to do with economic growth and the investor risk preferences. And when investors have low risk preferences and when market has high growth rate, then ERP is supposed to be a low number. And when investors have high risk preferences and the economy slows down, this number will go upwards. And the second tool that we use to estimate ERP is so-called implied ERP. We look at market index and use a 2-stage model or constant growth model to estimate the implied ERP. And actually, the first step is to compute expected market return, and then you take the difference between that expected market return and risk-free rate to get so-called implied ERP. So that is a cost of equity, just one equation based on capital asset pricing model. Cost of equity equals risk-free rate plus beta times risk premium. And I want you to know that as a professional financial analyst, now you have a big toolbox to deal with this cost of equity estimation. In the future, if you needed to do any stock valuation, the first thing that you needed to do is to look at its cost of equity. You do need to do a lot of work to deal with first one, risk-free rate, and then you move on to deal with this beta using multiple method, and the last one is ERP. So that is the first step for you to do any stock evaluation, to get a cost of equity based on 3 important parameters. There are two additional issues associated with this cost of equity. The first one is debt ratio versus net debt ratio. And typically, it's not a big issue when a company doesn't have large amount of cash sitting on their balance sheet, because cash generates zero return. If it's small amount, that doesn't matter too much. But if a company has significant amount of cash sitting on the balance sheet, then we needed to use the alternative debt ratio, which is net debt ratio. And the net debt ratio is computed based on the net debt. The net debt excludes cash from the total amount of debt. As I said, if cash the amount of cash is small, it doesn't matter too much. But for a company that has a large amount of cash, then it's better to use the net debt ratio. For example, Apple has $100 billion sitting on the balance sheet, and when you look at the debt ratio, when do you use that debt ratio? Well, we use that ratio calculating levered beta, right? So for the company that has a large amount of cash flow, if you use that ratio, then it's likely that you may underestimate or overestimate this levered beta. So yeah, make sure you understand the difference between this net debt ratio and debt ratio as well. And two additional consideration. First one is country risk premium. Once again, you shouldn't double count country risk premium in both risk-free rate and ERP. Right? You only do one. You put this country risk premium in either the risk-free rate or ERP. Best practice is to add this country risk premium into active risk premium part, not in the risk-free rate part. And the second additional consideration is small company premium. The CAPM model that you see here doesn't include growth effect and small size effect of the company. As you see, most regression can only generate, let's say, less than 20% R square, which means only 20% of variation in stock return can be explained by beta. And we have other factors that can explain stock return, and a small company premium is one of them. The other one is growth company premium as well. So for small companies, especially for small companies, when you estimate this cost of capital, you need to be careful, because if you only use CAPM model, then you may underestimate its required rate of return. And therefore, you may overestimate a small company's stock price because you overlook this small company premium. For small company, it's better to, once you get a beta, then you need to get another proportion of the riskiness required return, that is small company premium, and it's better to put this small company premium into your estimation as well. Previously, CAPM model is a standardized model for financial analysts to come up with this cost of equity, but nowadays people use three-factor model. Three-factor model is also called from a French three-factor model, which includes not only beta but also small company premium as well as growth company premium. And in recent years, people began to use four-factor model, which incorporates four factors. First one is beta, second one is size effect premium, small company premium. The third one is growth company premium, and the last one is momentum premium. Right? So just to give you a little extension on this cost of equity estimation. So nowadays people use three-factor model or four-factor model in addition to the standardized CAPM model. Now let's move on to discuss second issue, the cost of debt. Cost of debt. And cost of debt is always hidden, because when you look at companies that has outstanding debt, what you can see is so-called interest rate or coupon rate. And a lot of people mistakenly use this number as the cost of debt, and I want you to know that this coupon rate, also called stated interest rate, has nothing to do with cost of debt. Okay, so that is a commonly committed mistake among investors. Then how to find the cost of debt? Cost of debt is always hidden. It's always hidden. And there are three major ways that investor can utilize to estimate cost of debt. The first one is year to maturity. Year to maturity is not there. The company doesn't disclose year to maturity of their bonds, and investors have to calculate year to maturity by themselves by looking at company's bond price on the market. Once you have bond price on the market, given you know the coupon rate, the principal payment, turn to maturity, then you can figure out this year to maturity. And the year to maturity is the return on that bond, and from corporation's perspective, that is cost of debt. So that is a year to maturity approach. And typically you can use Excel spreadsheet or financial calculator to calculate this YTM, or year to maturity, based on basic information that you know of the bond as well as the bond price. And second method is what if the company's bond is not tradable on the market or not actively traded on the market. That is pretty common because there's a total of more than 1 million existing bonds in the US tradable on the market. However, most of them are not actively traded. There's only 7,000-8,000 issues of bonds are actively traded, but the rest of those, almost 1 million of those, are not actively traded. So if they are not actively traded, then you may not have the access to bond price. Then it's impossible for you to calculate this yield to maturity. So for that kind of bond, how do you get this cost of debt? Well, the answer is here. You look at the credit rating of the company, and then estimate a default spread based upon its credit rating. And this is a pretty robust method. And let me show you one table. And this table showed you that the bond with different credit rating have different default spread. For example, for single A rated bond in year 2003, the default spread is 1.8%. For triple B rated bond, the number is 2.25%. For triple C rated bond, that is 10%. So the lower the bond rating, the higher the default risk. The cost of debt equals risk-free rate plus default spread. So in this example, let's say in year 2003, if you are estimating cost of debt for a company that has A rated bond, then default spread is 1.8%. Let's say in year 2003, the risk-free rate is 2.5%. The cost of debt would be 1.8% plus 2.5%. That's how you calculate cost of debt based on default spread, which is reflected in its bond rating. And this the default spread changes over time. As you see in year 2004, for the same A-rated bond, the default spread is 0.85%. So this default spread changes over time. So be careful. In the textbook website, the author of the textbook developed this default spread on a yearly basis, and you can see most recently updated information on default spread on author's website, and in the textbook you see old numbers, year 2003, year 2004, but on his website you will find the most recent numbers such as year 2019 or year 2020 regarding this default spread based on different credit ratings of corporate bonds. So that is the second method to estimate cost of debt. What if a bond is not listed on the market, and the company doesn't even have credit rating? In that case, how do you come up with cost of debt? Here we need to use the called synthetic rating approach. Right? And the synthetic rating approach is simply look at a company, look at its financial characteristics, and to estimate its credit rating first. And then you look at default spread. And here's one example. Let's say we are estimating the cost of debt for the company called Embraer, a airline manufacturer in Canada. This company has debt outstanding, but the debt is not tradable on the market, and there's no credit rating. So here, first step is to do the credit rating evaluation. I mean, it's not rated, but we wanted to know if it's rated, then what would be the credit rating of this company. Right? And the credit rating company use financial characteristics of the company to evaluate its rating, and we use the same method. And here we use one of those financial characteristics, interest coverage ratio. We look at this financial ratio to see what level it is, and then compare this number with the comparable companies that has credit rating on the company, so we can get the comparable credit rating as well as default spread. So if this company has interest coverage ratio in year 2003 of 3.56, and this 3.56 interest coverage ratio is corresponding to A minus credit rating. And in year 2003, the default spread is 2%. Right? So it's comparable financial ratio leading to comparable bond rating as well as comparable default spread. So roughly speaking, the quality of the company is similar to those rated as similar to the company that has A minus bond rating, which carries 2% default spread. If that is the case, then the cost of debt of this company equals risk-free rate plus this default spread of 2%. So that is a synthetic rating estimation of cost of debt. We use financial characteristics. Sometimes, I mean, here you only use one ratio. In most cases, you wanted to use at least 3 ratios: interest rate, coverage ratio, debt ratio, maybe other ratio. At least 3 critical ratios to do the comparison to see what is most reasonably estimated bond rating for that company, as well as its default spread. For foreign companies, you start with the risk-free rate, then you add country default spread and company default spread. And in this case, for Brazil company, the risk-free rate is 4.29%. The country default spread is 4%, and the company default spread is 4%, and the company default spread is 1%. You add 3 components together to get estimated cost of debt of this foreign stock. Okay, we get cost of debt and the cost of equity, and in most cases, if you use free cash to the firm model, then you need to get cost of capital, or weighted average cost of capital. And this rate is very important discount rate if you use firm cash flow related model, which is pretty popular nowadays on Wall Street. Free cash flow to the firm model. And this model asks you to estimate the value of the firm first, then you exclude the value of that to get the value of the equity. Right? But the first step is to estimate cost of capital, right? Also called weighted average cost of capital. And just the average cost of debt and the cost of equity. And here you needed to compute the weight of equity and the weight of debt. How do you do the weight calculation? Well, we do calculation based on market value of equity and the market value of debt. And the market value of equity is significantly different from book value of equity, and we always use market value of equity in calculating the weight of the equity. And for bond, if bond is tradable on the market, that's okay, but in other cases, it's not. Therefore, the only number that you may have is the book value of the bond, And here, a lot of people use the book value of the bond in their calculation. I would say it's okay. It's not accurate, but it's okay because the book value of bond and the market value of bond doesn't deviate from each other a lot. But for distressed companies, it may be a different issue because for distressed company, the market value bond could be significantly lower than its book value of the bond. But for healthy companies, for companies that has relatively high credit rating, it is okay. I said it's okay. It's not great. It's okay to use book value of the debt in calculation. But in theory, you need to look at the market value of the debt. Just that the market value of debt is hard to get if those bonds are not actively traded or listed on the exchange. You don't know the bond price, then how you get the cost, how you get the total market value of the debt. So book value of debt could be one way to go because you don't have any other information about market value of the bond. So that's weight calculation. Now, we have a little bit more additional stuff to deal with. That is hybrid, and preferred stock. Hybrid could be convertible bonds that a company issue. I mean, it looks as bond, but actually, convertible bond can be viewed as hybrid of stock and bond, or equity and debt. And the preferred stock looks like stock, but actually it's another type of hybrid because preferred stock can be viewed as stock plus option. So let's see how do we decompose a convertible bond into equity part and the debt part in your weight calculation. Let's say a company has 125 million face value of convertible bond with stated interest rate of 4% and it's 10-year bond. And the market value of the bond is 140 million US dollars. So the total value of this convertible bond is 140 million. However, we need to decompose this 140 million US dollar into the true bond value as well as the option value, and then this option value should belong to the equity of the company. So if the company has a bond rating of A and interest rate on A rated bond is 8%, which is the year to maturity or required rate of return or cost of debt, A rated bond is 8%. Then we can break down the value of convertible bond into two parts: the straight debt value as well as the option equity value. In order to calculate the debt value, we look at the present value of this debt. We compute present value of coupons, which is 4% of 125 million US dollars each every year, and you will have 10 years of coupon payment, and then the discount rate is 80%. You can use Excel spreadsheet or the financial calculator to calculate present value of this annuity, 10-year annuity. Then plus present value of the principal payment, $125 million principal payment in 10 years with 8% discount rate. And when you put those two parts together, you get a $91.5 million market value of a straight bond that doesn't carry any convertible provision. And the difference between the market value of this convertible bond and the market value of this straight bond would be the option value of this convertible bond, which is $48.55 million US. So here we decompose this 140 million US convertible bond value into two parts. One is straight debt value, which equals $91.5 million US, and its option value, which belongs to equity proportion of the capital, which is equal to $48.55 million US. And convertible bond, preferred stock. You may not find those hybrids in each every stock, but the Fosun company they do carry convertible bonds, and actually convertible bonds are pretty popular nowadays. Preferred stock is old-fashioned way of raising capital, and in those mature company, you may find a lot of company has preferred stocks as well. And for preferred stock, you use preferred dividend yield as the cost of preferred stock. So here is cost of capital, the weight of equity times cost of equity plus weight of debt times cost of debt, then times 1 minus T. Why do we need to add this additional part? Times 1 minus T, because debt financing has tax benefits. Because the interest rate the company pay is tax deductible, therefore cost of debt, the after-tax cost of debt is lower than before tax cost of debt. So that concludes this chapter 8. Chapter 8 is a big chapter. First of all, we have a lot of materials covered in estimating beta, and then we have discussion on cost of equity, cost of debt, and weighted average cost of capital. Right. So at this moment, I think you should be able to deal with a lot problems in your first exam. I highly recommend you to work on those problems and questions this week, and it will be due next week. So yeah, that's chapter 8. Thank you so very much. I hope you enjoyed this video, and I will see you very soon.